It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today we have one of our most favorite guests, John Burley. He's been with us a number of times. So, John, welcome to the program.
Thank you. Great to be here again. Appreciate it.
You're welcome. Anyway, if those of you that don't know who John is, he's a real estate investor, educator, owns a private equity company starting actually in 1989. So, John, you've done a lot of real estate in Arizona.
Done a lot. Company's located here, and yeah, we've done thousands and thousands of transactions here in state and 11 other states as well.
Right. Actually, I shouldn't say in Arizona, all over the place.
Yeah.
And also a best-selling author of Money Secrets of the Rich.
Yeah, very blessed with that book. Over 1 million sold in overseas and then in the United States. Hit number one. Actually outsold Harry Potter for 2 weeks a few years back.
That's pretty impressive.
Yeah.
That's awesome. But I asked John to join us again, like I said, because I've often shared, John, I don't know anybody that knows more about real estate than you. And so if I have a real estate question, you're the guy I go to.
Yeah, we've had some fun conversations over the years for sure, and it's an exciting time right now. A lot of
Yes.
stuff out there, and a lot of amateur experts.
Absolutely. So we're going to get into it. I asked John to join us again because, again, he's been one of our favorite guests. But as I mentioned, I called him a week or so ago, and he said, John, the Federal Reserve has now raised interest rates. They are stating that they're going to raise them basically about 3% over the next year and a half, roughly, by end of 2023, which, folks, like I've been sharing, if you heard in the last show, that means a 3% mortgage, for example, that you could have gotten a few weeks ago will be a 6% mortgage in a year and a half. So, John, how do you see all this stuff going on now affecting real estate?
Yeah, so a couple different things. So certainly, are we in some recessionary times? Absolutely. Do recessions always hit equity markets? No. Matter of fact, the last 6 recessions, only 2 actually had a negative effect on real estate. So it's not like a given thing. I think what people need to do, the first thing everybody's like going, oh my God, we're going to do 2008 all over again. Okay, first of all, 2008s are 65 to 90-year phenomenons that you can chart and track. So the last one was 1932. The one before that was 1870. The one before that was 1790. And they literally have charts, as you go to Europe and Asia, that go back 6,000 years that track these as basically an every 3 or 4 generation phenomena. They've never happened back to back. Doesn't mean they could, just means they never have.
Okay.
So when I look at this, and compare it like with the 2008, which because everybody, especially all the amateurs who haven't been through it, and let's face it, there's a lot of money in predicting doom and gloom, and a lot of people are really good at. You and I share a friend who literally, since 1992, was swearing that America was going to crash, die, and go bankrupt. He kind of missed the mark so far. Doesn't mean it can't happen someday, just it's been a long time without it happening. When I look at the market, when we were in 2008, you had over 200,000 vacant doors just here in Maricopa County. So we'll kind of bring this to an Arizona conversation.
Sure.
Today, it couldn't be more opposite. We have a shortage of doors, and we're completely not overbuilt at all. In fact, in America, if we go back the previous 60 years, previous 6 decades, we did 25 million plus new home starts in the country. Last decade, we did 5 million. So, I mean, it's completely out of balance, supply and demand. The other thing last time is lending was just funny money. I mean, it'd be very typical to see somebody who had 4 or 5 houses who literally was 10 grand in, all of them negative cash flow because interest rates were 7.5, which is kind of funny for perspective. People are crying about we went to 4.
Right.
But everybody went in before it went 7.5. And so the interest rate, the money in is so different. Today, an investor's putting 20 or 25% down. We're not doing no-doc loans. We're not doing funny loans. And almost every single property, especially in the single-family home, Class B, they're all positive cash flow. Before the big rent increase of the last 2 years, they were already positive cash flow. So you've got the fund people that have come in, and Phoenix is one of their darlings. So a huge amount of the investment property, first of all, is free and clear. There is no loans. Interest rate will have no effect on its performance because there's no loans. Because the big funds buy all cash like lots of my clients do. The next thing is that the people who do have loans that are investors, they had to put $50, $60, $80, $100,000 down, which is a whole different walk away from no money down. And where last time they were negative cash flow, this time they're positive cash flow. So we had one of the largest portfolios if not the largest portfolio in Phoenix when the last downturn came. If you were to look at 8, 9, 10, 11, 12, go out 5 years, during that period of time, 91% of our residents did absolutely nothing but stay and pay. And the other 9% that turned, in a few cases, we got lower rent, but in many cases, we actually got higher rent. So for the long-term players, the non-speculators, those who bought for good, positive cash flow, there's going to be a bumpy ride for the rest of the world, but not for them. And as far as a downturn, I think it's the same thing we were talking about it just before the COVID thing came and kind of threw a whole new dynamic never seen before in modern world on a financial level. We are at and due for a normal downturn, which is a 10 to 20% max, but it has virtually no effect on the income streams.
Right. I liked one of the things you brought up is the speculators. So one of the things I've been noticing, and I've got a lot of folks I've talked to, some are even clients, who they borrowed money to do the Airbnb thing. And now before we get on, I was looking for some vacation rental, on Airbnb for, I'm seeing prices like dropping like a rock. I mean, we're talking about half off, 2/3 off reductions. How do you see those people being affected by all this? And will that maybe, if they're getting out, maybe bring some more inventory available, let's say?
Yeah, absolutely. So the Airbnb right now was already looking at 2 challenges, and they have a third. Mm-hmm. I mean, the first challenge was it's been oversaturated. So many people are teaching how to do it, waving it as the next magic wand. Of course, there's never been a magic wand that worked, but people are going to keep waving those. So you've got too many people doing it. The big thing that Airbnb has kind of really been facing over the last few years, but now facing strongly over the next 5 years, is community after community are doing everything they can do to restrict, outlaw, and govern it. Because let's face it, if you own a nice, great home, you don't want an Airbnb next to you. That would be like the worst thing that can happen to your house. And I've rented somewhere. I mean, the neighbors were really hostile towards you because you're just another party person. And I know here Paradise Valley just passed their first wave of legislation that works within the Arizona Constitution, because we have a constitutional amendment that doesn't allow communities and towns and cities and counties to do rent control and change all the rules, which is a great thing that we actually have it. But what a lot of communities have done, if there's an HOA, they're limiting short-term renters to 32 days, which whacks out the Airbnb. You've also got, like Paradise Valley, you can't be outside from 7 p.m. to 10 a.m., which is rather restrictive for an Airbnb. And then the other thing you've got so you've got too many people doing it. Mm-hmm. You've got local ordinances, which are just going to continue to come because they went too far. The investment community went way too far because they can't help themselves. And then the third thing you've got, obviously, is the economy is not as good. People have a tendency to hunker down, not take those big splashy vacations, not travel as much. Vacation destinations are always hurt, and the more expensive and the nicer they are, the more they're hurt in the downturns. So I think they've got a triple whammy that's real. Again, if you bought well or you buy well and your numbers are good, it's just a normal recessionary downturn, and all good businesses thrive through those and survive.
Right.
Bad businesses don't.
That's a good point. And I guess that's something, anytime I talk to somebody, I get this question a lot, what about real estate? And I always say, look, if somebody is interested or considering in real estate investing, or maybe they've done some of it and things aren't working out as they had hoped, I always tell them you need to get the education. And that's one of the things I think John maybe might do the best is the education side. I know you have a spring training event coming up here very soon. Can you tell us a little more about what it's about and what?
Yeah, we do 4 events a year. So my primary business is private equity founder and CEO. We do a large investment company. We're actively investing right now here in Phoenix. We do the 4 educational events a year. The next one is April 2nd to 4th, where the primary focus is on raising capital and understanding how to use leverage properly. The following weekend, the 8th to 10th of April, we're going through and how we find real estate deals, how we buy off market, how we buy below value in 2022. Because as you know, there's still good deals still happen all the time. And then just how we cash flow. One thing that's interesting is my background's out of Wall Street. And so I look at real estate foundationally and fundamentally, as you know, different than anybody I've ever met in the real estate game, especially the real estate education. To me, real estate has nothing to do with real estate. I'll say it again. Real estate has nothing to do with real estate. It never did and it never will. Real estate is entirely about money. If you understand how to raise it, how to have it at a low cost, if you understand the return rather than the price, because many of my students and I are actually over the last 2 years making higher rates of return than in 2012 buying on the bottom. Because obviously back then rents were really, really low and financing was unavailable.
Right.
You know, so today, even with it moving up, if we look at it historically, if we look at it with a level head without emotion, interest rates are still incredibly low. Tons of value to buy, but you have to know what to buy and where. So, I mean, am I buying the county? Heck no.
Right.
Am I buying in specific areas for good prices, for high income streams? Absolutely. But we've got to be good at what we do right now. You can't just, it's not time to just close your eyes and buy the whole place.
It's not time for amateur hour.
No, it's not amateur hour. No, amateurs get fleeced pretty hard in these markets.
Right. So where would somebody, if somebody's interested in getting more information, attending the spring training, where should they contact you?
Yeah, go to johnburley.com, JOHNBURLEY.com. There's some great free downloads there. I encourage you to get those, and you can find out the event. You can also email us, Chrissie, KRISSIE, at johnburley.com. She takes care of all of our bookings and our students. You can also call the office, 623-561-8246. We've even got a John Burley Real Estate Facebook page if you want to hop in there and ask a question and learn more.
That's awesome. So we're going to have John with us the entire show today, folks. So I'm going to really encourage you to stay tuned and listen to more, because I'm going to have John. There's something called the Burley method or in real estate. And I'm going to have John kind of explain or share a little bit more about that as we go through the show and coming up. But I'll tell you what, we've got about 30 seconds, John. What is the 30,000 foot view? What is the Burley method?
Burley method is, first of all, own homes. We do it as a portfolio. We were the first ones to do it in '89 before Wall Street. Own homes in solid Class B, safe and secure neighborhoods, long-term for cash flow. We provide the resident the opportunity to own the home. We provide a capital investor or ourselves a great return. And then if you don't have your own money to do deals, we teach you how to raise the money so you can get in the game efficiently and quickly.
Well, that's awesome. So like I said, contact John at johnburley.com. And, of course, if you want any more information on your personal bank, because this is a special interview we're doing with John, of course, but you can contact me at yourpersonalbank.com. So stay tuned in the next segment. It's going to be a fun one. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And of course, today we have a very special guest, actually one of our probably our most popular guests. John Burley is joining us again. John, thanks for joining us today.
It is awesome to be here. And I love talking real estate and money with you. Always a good time.
Excellent. Like, again, as John knows, we've become good friends over the years. And I called John up about a week ago. I said, hey, the Federal Reserve has raised rates. People are asking me a lot about real estate and what to do. And I said, John, would you come back on? He's very graciously joined us. But what I want to talk about now is, again, more about what is it you do, John? You've done well for 30 years plus, right?
Yes.
And how you approach real estate investing.
Yeah, so when I learned real estate, I did it part-time like a lot of people, starting way back in the late 70s, early 80s. I wasn't even 18 years old when I started trying to do real estate deals. And what I learned then was in a Wall Street background, and what I learned really was that real estate foundationally and fundamentally was just an asset class. It had absolutely nothing to do with real estate. It was entirely like money, like all asset classes. And most people looked at it far too emotionally. Most people didn't look at it as a business. When I formed my private equity company in 1989, at that point, no quote-unquote Wall Street company, they're not out of Wall Street funds and different stuff, but people just call them that. None had ever done single-family homes. We all always knew they worked, but no one wanted to do the work. And most of the funds, 98%, get paid for fees regardless of performance. So, and I got it. It's like, geez, if you had $30 million to place, what do you want to do? Run out and buy $100,000, $300,000 homes and go buy one building? Well, one building is way less work and you get paid the same. So we opened it, but on the private equity model, whereby I was only paid for returns. So if I didn't make money, I didn't get paid, which was, revolutionary, and still today revolutionary. Only 2% of the investment firms actually work for returns. 98% work predominantly for fees. And so we went out, and in the first few years, we bought several hundred houses here in Phoenix. Pretty much every mistake or thing you could do wrong, I did, which is how you foundationally learn everything. Today people benefit because I just tell them exactly how to do it, but that's based not on the wins. That's based on what went wrong. And they weren't big losses or anything. Just, we screw this up and screw that up and, all the things you don't want to do. So we really perfected a model by 92. And we've expanded. We've invested in 2 different countries, 11 different states, but our corporate offices and our main focus has always been here in Phoenix. And we buy lots and lots here throughout all the different markets. What I look at it is not the price. I look at the return. You can really tell the level of expertise because so many people are just all worried about the prices with like no concept of the returns. Because quite frankly, we made more on property we bought in 2020 than we bought in 1990 or in 2012 coming out of the crash. We actually have a higher rate of return because it's about the return. And we're long-term players, which is where most people want to get to in real estate. Maybe they're not there yet, but it's just because they haven't learned how. And so we look at the cash flow, the rate of return. And right now in Phoenix, there's volatility in the markets. Volatility is good. There is a lot of emotion in markets. A lot of emotion is good as long as you don't get caught up in any of it. So we just look at them as silly old investment properties. We took the Wall Street and the institutional side and apply it to homes. We were the first people to do it. And so what we do is, first of all, we take care of an end user. We put in someone who's going to be an owner. So they have far more vested in making sure they take care of the home. I mean, we're stereotyping, but overall, owners take way better care of their homes than renters. Overall, owners stay in their homes way longer than renters. And, and today it's like most of my residents, would be secondary financing. So they're maybe 30, 40 FICO points on a very flawed model, but they're 30, 40 FICO points away, which is usually just, like a medical collection, not paying for a cell phone bill, being late on a utility bill. Nothing has anything to do with paying for it, but that screws their credit up. I think a lot of people listening to what I'm talking about. They're 30, 40 FICO points away from getting a $700,000 loan. And we put them into a $350,000 home they can afford and pay for, good times or bad. Because I always know bad times are always going to come again. They always have. They always will. It's just a matter of how big and when. And so we give them a home that they can win in. They can afford to move into it. They can afford to pay for it. They can afford to take care of it. So our whole model was always designed around taking care of the residents. And many of them stay for 10, 20, 30 years and end up owning the home. The next thing we do is, if you're listening and you have your own capital, your own money, your own ability to borrow, well, then you come to our events and you run with that first. But a lot of people can only buy none or a couple houses and then they're shut out. Down payments are real these days. They're 20, 25% for investors for the most part. It's not the old days of no money down and negative cash flow. And so
I remember those days. One year, I'd got to say this. I remember remember putting $10,000 down per house, bought 13 houses that year.
Right. And a few years later, they weren't worth much, which is one of the reasons why we had the last big correction is because the investors just bailed. Because they had put no skin in the game. And it's one thing to walk away from 4 houses that you put $30,000 on that lose money and aren't rented, where today it would be 4 houses that you put $400,000 down on and they're rented and it's positive cash flow. It's a totally different scenario than 2008. You're not walking away from it.
No.
When people start talking about that, it's like going, okay, I hear your emotions. I hear your lack of logic. I hear your refusal to look at any of the previous data while trying to cherry pick data that supports your position. You have to look at all the data, not just what you want to look at. And then we bring in the capital investor, which, starting out was, hey, friends and family, and it wasn't that they were buying a house for $400,000 or $500,000. They were coming up with the down payment and signing for a loan. And we do a JV. Most of our students do a JV partnership. It's a business model. It is not a security when you do it right.
For those that don't know what that means, what is a JV?
JV means Ference and I He comes to me and he wants to put up money to buy some houses, but wants someone like me to do it rather than himself. And so we form a partnership, a business. And the purpose of the business is we're going to buy a set amount of properties, and we're going to do all the management and all the work. He's going to put the capital. He's going to be involved in some meetings because we need to have it be real. And then we're going to go and invest for the long term and make what is today spectacular rates of return.
If somebody was looking at doing it or interested in doing that, what's a typical amount they would need to invest for a down payment on a house today?
Yeah, here in Maricopa County, people are looking at 75 to 100 grand, and I'm not here to solicit funds.
Understand.
But yeah, at $7,500 would be a normal entry because I'm not buying junk. I don't buy Class C properties. I love that Wall Street made up Class D, like Class C wasn't bad enough. Class C is what you do when you go to the bathroom. We all know what it is. If we weren't on the air, I'd say the word.
Right.
And we didn't need anything worse. So we buy solid Class B, middle class, long-term holds because they make the most money by far. They make more money traditionally than multi-units. We own all the different asset class of real estate. I mean, I've got mini storage, I've got warehousing, I've got office, I've got all the different commercial multi-units. I make a higher return on the residential when managed properly, and it's the safest. Because when there are corrections, people always need solid middle-class housing. Families always need a place to live, and we provide that for the long term. And so the capital investor puts up the money. We take care of the family first, then we take care of the capital investor. We let it run for the long term. We maximize the returns. I mean, we obviously, as you know, because you've been to our training for, we have systems for everything all spelled out. But the big picture is, hey, provide a family a home.
How do they contact you real quick, John?
Yeah, you go to our website, johnburley.com. There's some free downloads about this, and you can learn about the event we've got coming up in April. You can call my office, 623-561-8246. And if you want, you can just hop on Facebook, go to John Burley Real Estate.
Awesome. Well, stay tuned. In the next segment, we got John for the rest of the show. So don't miss it. And, of course, if you want to contact us, yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And today we have one of our favorite guests, John Burley. So, John, again, thank you for joining our program.
Fantastic to be here, my friend.
And if you missed it before, I'm going to just tell you, go to yourpersonalbank.com. You can listen to the previous segments because John is a real estate expert. He knows more about real estate and has more experience with it than anybody I know. He's my real estate guru that I go to. And like I said, you can listen to that or any of the previously recorded shows on yourpersonalbank.com. So if you missed it, go there. John, we've been talking a lot about owners of real estate. We've been talking a lot about investors of real estate. But what about those folks out there that are renting?
Yeah, so right now in Maricopa County for renters, they've got a little bit of sticker shock along with the rest of the world. Prices are going up to own, which isn't necessarily a bad thing. And obviously, if you've been owning real estate, it's been a joy the last 2 years. And I have a lot of real estate, but I'm aware that it comes up and goes down. That's just part of the nature of the animal. Here's the thing that a lot of people don't go. People in Phoenix, and I talk to a lot of people, as you know, a lot of them, I get this, they form a lot of biases. We're all biased. The most biased man or woman is the one who doesn't admit their own bias. I really have developed skill sets to look way beyond my own bias so I can understand better what's going on and position myself to take advantage of those opportunities. For the most part in Phoenix, if you were to look at our rents and charts, our rents we're by far, so we're the fifth biggest city in America. Our rents are by far the lowest of any major city. It's not even close. Our real estate is the most undervalued of any major city. It's not even close. So people in things like, oh my God, it's so expensive here. I'm going to go buy, a house out in Timbuktu, Oklahoma, for 60 grand. There's a reason it's only 60 grand. It never goes up there. They don't have consistent growth like a Phoenix does. And Phoenix has always been a very moderate growth and then spikes. And then some retrench, and then moderate growth and spike. This is the nature of this city. It's a high-growth city. This is what it's always done. None of this is a surprise to anybody who's been around. None of it.
Right.
So when people are surprised, they don't know what they're doing. It's plain and simple. On the rent side, most of the rents that we've put up in the last couple of years, and it's the most I've ever seen in Arizona, not other markets, but in Arizona, Most of this has really just been catching up and getting in line where it always should have been. Renters got the deals here for a long time. They're now moving more up in line. And I'm sorry if you're getting squeezed with that. I didn't do it. It just is. Most landlords right now are passing on 10% or so rent increases per year if they run their business properly, because it's just a business and you want to monetize when you can. I think that moving forward over the next couple of years, the rent increases will level off. They'll go back more to normal as there's been a catch-up. But those rarely retrench. And so, for being a long-term investor, it's just a spectacular opportunity, because even with the interest rates creeping up and moving up over the next couple of years, when you look at what our debt service is, so look at it from a business, that principal, interest, taxes, and insurance, the old PITI,
right,
and our maintenance and management costs, when we look at those versus the rental income, the returns are spectacular. So, in the last couple of months, we've had several properties that are in that $1,200 to $1,500 a month complete debt service. And our income streams are $2,100 to $2,400 a month. So our positive cash flow numbers have been, for the last couple of years, on the low end, $600 a month per property, and most of them in the $800 to $1,000, some of them $1,000 plus. So the returns are still very, very good, even if the real estate never goes up. And quite frankly, if you're a long-term player, you really don't care if the real estate goes down, because if anything, your income stream is more valuable, not less. And
right.
I don't have to sell when the market's down. It's not a stock on a margin call where they're going to call the loans. I just do nothing, which is, as you know, it's one of the reasons you were first, attracted to what we did, is because we had thrived through the downturn. So 8, 9, 10, 11, 12, with most of our properties, we just did nothing but
right.
collect a check every month.
Well, that's one of the reasons, too, why I recommend people to go to you for the education if they're considering real estate investing, or even doing it and not succeeding like they want to. It's no different than when I say, if you're going to work with a financial advisor, if you've worked with someone with less than 12 years experience, all they've known is an up market.
Right. And it's like, and this is never meant to offend anybody, but this has been the
right.
same on every downturn I experienced. Right now, I really don't have a whole lot of interest in hearing what anybody has to say who was not in the business in 2005 or 6.
Right.
Because you have no idea what happens, and you have no idea that there's even a train on tracks. Heck, you don't even know there's train tracks and one's coming down.
And all that sticker shock and how to deal with it is all. I always tell people, do you want to be their guinea pig while they learn how to adjust to a different economy or different market?
Yeah, where ours is all a system and a model. When the economy and the market switch, we just switch. I mean, we've already done it before. None of
right.
this is new or a surprise.
All right, we're coming up on a hard break here. John, one more time, how do they contact you if they want more information?
Hey, the easiest way, go to johnburley.com, JOHNBURLEY.com. There's some free downloads there. Do the downloads, and then as we have updates that come out, we will not inundate you. When we send updates and market updates on what's going in the market, you'll get an email telling you about it. You can check it out. You can also learn more about our events. You can call us. Thank you.
All right, and stay tuned. We got one more segment with John, and again, if you want to contact me, it's yourpersonalbank.com.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and of course, we have probably our favorite guest we've all had on this show, John Burley. Thank you for joining us again, John.
Incredible to be here as always, Ference.
It's fun. It's fun. And like I said, and if you missed it in the first segment, I'm going to say again, you can go to yourpersonalbank.com. You can listen to the previous segments or any of the previously recorded shows for that matter. But John and I started the show off, we were talking about, and the reason why I called John to come in was, well, the Federal Reserve is raising interest rates. It's going to be probably the most aggressive interest rates we've seen for increases for at least 20, if not 40 years. And there's a lot of people concerned about the economy and everything else, but specifically real estate. We talked about this a little bit in the first segment, John, about how the person, say, is looking at buying or selling a home right now. How do you see that affecting them? What should they do?
Yeah, so a lot of people think of me and look at me as this like super incredibly creative real estate guy. And the reality is it's not the case. So I'm the founder and the CEO of a private equity company, which means over the years, thousands of families have placed their trust in me, primarily not to lose their money. And so I've always looked at my job as a founder and CEO, who only is paid by profits, is to reduce and mitigate risk. So everything I look at in our model is how do we reduce and mitigate risk? So things like interest rate spikes. I mean, heck, I was around when, the President Carter took us to 19%.
Right.
For perspective for your listeners. And from then until 1993, I dealt with interest rates that were over 10%. I mean, 1993, it dropped to 9.75%, and we partied that night, let me tell you.
On that note, I mean, I have a lot of people saying, oh, well, this is temporary. It's going to last so long. I said, inflation's one of those genies. You once it comes out of the bottle, it's really, really hard to put back in. Folks, I think we're going to be dealing with high interest rates and high inflation far longer than many people think.
Yeah, I think they're here to stay for a while. It's certainly what this administration wants to slow it down. Regardless of political party, both parties have proven they're pretty ineffective at dealing with inflations.
Right.
Interest rates have not proven an effective monitor, and usually when they start to deal with it, it's already too late. So the genie's already in the bottle, and they're trying to stuff it back in. And raising interest rates half point doesn't change it.
That train left the station a long time ago.
Right, and it's just a matter, whether one is sophisticated, knowledgeable enough, and trained enough to deal with the opportunities that are created by the chaos.
Right.
And this is when people who know what they're doing make the most money, when there's chaos.
Mm-hmm.
So the government's creating chaos. Again, they're very good at it. All administrations in my entire life created some opportunities from their chaos. We got one right here. So first of all, I mean, the debt service of ownership and investment is going to increase, which is why I know a lot of people are very aggressively trying to position themselves and buy more now. We've also got at the same time, rents have just been doing a rebound, quite frankly, to where they should have been. Rents in Phoenix have been so low. I know many of you out there have sticker shock, both as a landlord or a renter. But the reality, if you look in a non-biased way at the charts and the numbers, our rents were so low for so long. I mean, literally, in 20 years, they had gone up a couple $100s a month, which isn't, while the buildings had tripled and quadrupled in value. This is not normal numbers.
Right.
So we're doing, unfortunately, for a lot of people, a catch-up. And they're not going to be whacking back down. And we're not in a state that runs around doing rent control. I know somebody was trying to pass that bill, but again, it had no shot. We actually have a 2006 constitutional amendment that they can't do rent control. So that to stop local communities from trying to, do stuff that most Arizonans don't want. And so, look, we've got some great opportunities if we can step aside from our emotions and not look at the price, but look at the return. We reduce and mitigate risk first. We buy very, very safe areas, very safe neighborhoods, primarily Class B. Single-family home right now gives us by far the better bang for the buck. And the reason is you've just got too much institutional money trying to buy those apartment buildings and the other stuff. It just is. And I don't fight the herd. I go where I can get the low-hanging fruit. So we're still buying a lot of great properties all across the valley. Our students are buying properties all across the valley. And the cash on cash, the cash flow returns are spectacular and will be going up. We factored in the increase, and it's going to tighten numbers over time. So people who are really looking at doing the real estate, the money in real estate is made predominantly in two portions of the market. The first portion is the portion that almost everybody misses, that always says that's what they're waiting for, which is the downturn.
Right.
And what I would just say straight up to most people, if you didn't crank in with everything you could possibly do in 2010 to 12, you ain't going to do it on the next downturn. Because the predominant fear is fear. The predominant emotion is fear. This is when the very, very mature, very sophisticated, very disciplined investors enter those markets, because most people don't want to touch them with a 10-foot pole.
Buffett always talks about it. He invests when there's blood on the streets.
Right, and most people don't. That's why Buffett is Buffett.
Right.
And you already missed that.
Right.
And it was a 3 or 4 generational phenomenon, not going to happen again next week like whatever Yahoo was telling you it is. Factually, there's just no precedent for it. There's no basis for it. The last big downturn was 1932. The previous big downturn was 1870. The prior one was 1790.
Right.
And
well, the fundamentals in real estate are, like you said earlier, totally different this time than they were in 08.
Yeah, completely. Are we going to have a downturn? Of course. We always have a downturn.
I think it's more of maybe more of a correction.
Just a pullback,
Yeah,
and normally
normal.
they're every 14 to 18 years, and normal ones are in the modern world in that 10 to 20% downturn.
Right.
We have such supply issues, shortages. I don't see that we're really having a big downturn, but certainly we're prepared for a 10 or 20 or 30% worst case scenario.
Well, John, that brings me to a question. Do you see that happening, say, in the Maricopa County market? Because we're also a net move-in area still, particularly a lot of people who are escaping other places like California.
So let me preface this.
Yeah.
I don't have a crystal ball, and nobody does.
Sure.
Anybody tells you they know what they're doing, in my opinion, is just lying.
Right.
When I look at all the numbers and I look at everything, do I see the possibility moving out a couple years of us having a 10 to 20% normal retraction in the market? Absolutely.
Okay.
That would be normal.
Right.
Because markets go up and then they come down and then they go up. Equity markets like real estate in Maricopa County have a long history of being dormant and slow, steady, and then a spike, and then a down, and then the same thing. So we always have been a wave city. It's one of the reasons why I invested here. You can get some nice pile-ons, just where they're huge, and usually what it is just catching up. So, we really didn't go down in 8 in this town. We went down in 7. We were one of the first to lead the crash.
Right.
And it was literally 18 or 19 until we just got back to even. So the whole
Back to where we were.
the whole 9 through 19 was just to get back to even.
Okay.
So if you were to roll back to 4
04.
and do a chart and run it to today, we're still just normal. We're 5-6%, which is normal for a big city with high growth.
Okay.
Because that's the normal return. So first of all, we're not out of line if you look at any logics. If you get out of the emotion and be a professional high-end investor, which is what people pay me to do.
Well, that's hard to do.
It's hard to do. That's why, and then they would say
not get emotional.
That's why some of us make the big bucks.
Right. Fear and greed move the markets, as they always say.
Yeah, and the markets are moved.
Whatever the market is.
Yeah, they're moved on emotions, not logic. The stock market moves more because you can get in and out faster, which means more emotion and more spreads and more plays.
Right.
And so, again, what I just come back to in this market is I'm looking at cash-on-cash returns. They're still solid. They're still great. Now, let me just say this to the listeners. In 4 to 6 in Phoenix, I was hard out. As you know, I was no longer investing in this marketplace. And again, not because I had a crystal ball or I was some, omnipotent investor. I understood 5th grade math.
The numbers didn't work.
Yeah, it was 7.5% interest. The house was $150,000. My PITI was $1,200 a month and rent was $1,200. That's a hard not go for a professional investor. I need to be making a great rate of return, and that wasn't. So we invested in other markets. So I look at my cash-on-cash returns. I never done marketing timing because you can't.
Right.
However, with that said, I allow a market to time me out. And right now in 2022, Phoenix has not timed me out. My returns are still there, so we'll continue to do placements.
The numbers are still working for you.
Yep.
Yeah, I think I like one of the things you always said, and this is something I learned from you, is like you said, real estate investing or whatever you want to call it is not about the price you buy or sell. It's the cash flow.
It's about the return.
The return.
And we don't sell when it's bad.
Right.
So if the market, people are like, what do you do if the market goes down? I would do the exact thing I did in 7, 8, 9, 10, 11, and 12. Nothing. I would hold on to my portfolio, which cash flows. During those 5 years, 91% of our residents just stayed in the houses and made their payments. The ones that turned, overall, we were making slightly more money. Some moved out, and I had to do a little less rent. Yeah, $100 less, $200 less max. And also many moved out, and I got to rent the house for more.
That's also because you do some due diligence before you let them in and get the right people in, right?
We screened, one of the things our investors love is we screened 6.5 residents for one person moving in. Okay. So we do all the possible testing, common sense, and normal parameters that we can do. I mean, because we want to make sure that the person that we put in the home can win and own it.
And that's risk mitigation.
And that's risk mitigation. And it's the responsibility of the person who's renting the property to not just put the first person in who fogs the mirror,
right,
but to really make sure they can make it work,
right,
for the long run. Because owning a home's not for everybody. I
think that's where a lot of people who try to rent properties, be landlords, I think that's maybe one of their biggest mistakes, allowing the wrong people in or not screening them well enough.
Yeah, it's an old saying, but it's so true. Many landlords, the majority of landlords, let the tail wag the dog, not the dog wag the tail. And we all know what that means.
Right.
The landlord needs to do full due diligence and not be emotionally involved with the residents, needs to get into the home. He needs to put somebody in who can afford it and take care of it where it's appropriate.
Right.
And it's one of the reasons why literally, most of our residents today, we're putting them in a $350,000, $400,000 home, and they are 30 or 40 FICO points away from getting a $700,000 mortgage. But they could never safely pay for the $700,000 home because when there's a downturn, when they're laid off, when there's inflation, then they lose their home. Well, that's only because they didn't take care of their own selves.
John, I've done a whole workshops on this where I say just because you get qualified for a $700,000 mortgage doesn't mean you should buy that. What that means is the banker is saying that's the upper limit that they're willing to risk the loan to you. You're pushing the limit, man.
Yeah.
So if they tell you 700, you should be like looking at 6 maybe at the max or something less.
Yeah, I don't blame them. I mean, that's because the banker or the mortgage broker makes more money the more you borrow. The realtor makes more money the more you buy.
Yes.
But it doesn't mean you should.
Right.
I mean, I could go get a loan for literally any house in Phoenix, but it doesn't mean I should buy them.
Right.
And so it's about being, we need to be fiscally responsible, so we need to make those choices for other people. And of course, in the market right now, it is crazy. The amount of people, when we have a property come available, the amount of people who want it. I mean, it is literally a couple of days with people putting up full deposits, full applications, everything in line, and we get to cherry pick the best possible resident for the property.
Absolutely. So if somebody's interested in more information on real estate or considering investing in real estate, or again, maybe it hasn't been working out like you had liked, John, you've got an event coming up, your spring training event. How do they contact you and get more information? Simplest way, go to johnburley.com, JOHNBURLEY.com. There's a couple downloads there that are free. Put in an email and get them. We're not going to take all your information, and we don't send out a bunch of mass emails. You're not going to get anything out. We send out some updates from time to time, what the market's doing, what's coming on. You can find out more about our events. You can also call my office, 623-561-8246. And hey, seriously, we're one of the biggest investment houses in the Valley. And if you've just got problems and you need help, call the office, leave the message, talk to somebody, and myself or one of my high-end members of my team will get back to you. What was that number again?
623-561-8246. We're happy to help out for free. You can also go on Facebook, go to John Burley Real Estate Investing, ask your questions, search other answers, lurk or get involved, whatever you want. So just, reach out to us, see how we can help you. We worked with lots and lots of investors here in the Valley, helping them their dreams come true. And we actually have thousands of students here in the Valley who have become millionaires.
And I can vouch for that because I've met a number of them, and some of them are my clients, in fact. So if you missed any of this show, and go to yourpersonalbank.com, listen to this or any of the previously recorded shows. John, as always, it's been a pleasure having you with us. We hope to have you again soon.
It's been a joy. Thank you.
All right. Thank you.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and writers may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.